All right. Thank you very much for having the paper on the program. This is a paper with Oliver Bogus at ASU and Vincent Grégoire at Université Montréal. When I first submitted the paper was preliminary, and it is still a preliminary paper. We're still debating on what should be the proper angle on how we should push forward with this paper. So we'll start with the motivation. So how can we measure information flow that affects equity prices? So when you have signed information, for example, earnings surprise from a news event, you can use returns. Now, if you don't know the sign of the effect, we can turn, for instance, to return volatility. In many classic models, stock prices only move with new information. In that case, the variance of return will equal to the variance of information flow. But what if prices can be noisy? In that case, noise can also affect return volatility. Therefore, the variance of return will equal to the variance of information flow plus the variance of noise. In that case, volatility is not a good measure of information flow, especially if noise is dependent on the information. In this paper, we propose a new diagnostic approach to measure incremental price informativeness or forecasting price efficiency around news events. Informativeness, in our case here, measures how informative are prices in absolute terms. If you look into Bruno Meyer RFS 2005 paper, he distinguishes informativeness from informational efficiency, where yes, informativeness do measure how informative are prices about future prices, and information efficiency measures how informative a price is relative to available information. So in our case here, we're only going to focus on price informativeness and not informational efficiency. So our measure is related to the difference between the variance information flow and the variance of noise. We'll be able to examine whether or not noise after a news event can subsume the information flow. We're going to apply our diagnostic approach to FOMC announcements from 2019 using market returns. We choose FOMC announcements because, well, they are probably one of the most, it is the most important macroeconomic news announcements, and they have on average large positive returns and significant resolution of uncertainty. So Pavel Saver, my discussant, has a classic paper with Nugo Wilson on the importance of macro news announcements, and Luca and Munch as well. And I've also did some work with my two co-authors on this paper on FOMC announcements, and they were spinning around FOMC announcements. So we know that FOMC announcements have large positive returns. So we need to provide some show how good our methodology is. We needed some news events that has large variation in returns. And it's important to tell you guys now that our method can be applied to multiple asset classes and to multiple news events. So the takeaway of the paper is the following. So how informative are FOMC announcements about future prices? Unfortunately, not much. It seems that post-FOMC prices contain more noise than information. Our findings actually complement a new forthcoming paper by Tim Kroenke, Mike Schmeling, and Adria Shrimp that is forthcoming in the GME. In their paper, they apply PCA to intraday returns following FOMC announcements to measure non-news component uncorrelated to risk-free rate surprises. They find that this non-news component impact returns on announcement day and mean reverts over 2-3 weeks due to price pressure. So them too, they also find some evidence of noise following FOMC announcements. At the moment, our paper, the contribution is more on the methodology side, where we propose a new diagnostic approach to measure noise. And this approach allows us to determine whether information flow or noise dominates price changes following news. So this is not something the paper by Tim Kroenke and co-authors were able to do. And also what's really neat with our method is that it does not rely on a predefined measure of surprise or news. So let me talk about the methodology. So actually our methodology builds on something that you might actually be familiar with. It builds on unbiasedness regressions. So for those of you who are not familiar with unbiasedness regressions, it's very simple. So for example, on the left-hand side of the equation here, if you have a long window return, so T-1 some days before a news event, T2 some days in the future after the news event, you regress this on a shorter window. So you start on a shorter window return. So you start from T-1 to time T. And what we do here is I'm going to run a regression at every small t up to T2. So T1 is the days that we're going to start before the announcement. T2 will be some future days after the announcement. And so we're going to rerun this regression for every given TT across event I. Bruno Biet, Pierre Lyon, and Chester Stadt, 1999, among others, use such regression to examine the slope coefficient, the beta t, as the beta t provides information on the speed of learning following news event. In our case, what we're going to do is that we're going to care about the change in the R-square from the unbiased regression. So keep in mind that we're going to run a regression every time t. So we're going to look at the change in the R-square from t to t. We'll then compare our change in the R-square to the random walk benchmark. So under a random walk with constant volatility, the R-square should increase linearly. Now, suppose on some day, we call it T star here, we observe a large absolute price change due to a news event. If this price change persists until the end of the window, T2, the change in R-square should be positive. We're going to call this information. If it's negative, we're going to call this noise. So our measure can accommodate both information and noise. And the change in delta R-square will measure the quantity of information minus the quantity of noise. So just for sake of illustration, we're going to run some, we'll just present here some simulation. So we simulate here a 10,000 price path, starting 10 days before a news event to 30 days after a news event. So the red line is assuming there's no news event at day 0, and the blue line it's for important price change at day 0. If noise or IID, and that the information at time 0 did contain some information about the future prices, and it's permanent, what you should see is that the R-square should jump at day 0. Okay. If on the day of the announcement, let's say we have on the day of the announcement noise increases but remains IID, what we would see is that at the announcement will be a decline in the R-square, but then on the next day the noise goes back to its normal level, and then the information flow gets impounded into prices on the day after. So it gets reflected into prices the day after. Now, in the case where noise is persistent, and let's say here in this case explanation, we have a geometric decay in noise. Now here what's going to happen is that noise will dominate the information flow. So what will happen is that on the day of the announcement, there will be no jump on the R-square. In fact, the R-square might actually decrease after the announcement, and it's going to remain actually below the linear line, and eventually it has to converge to 1. Okay. So the results. So what do we see when we do this approach for the FOMC announcement? What do we observe? Here, we're going to take 10 days. We're going to start 11 days before the FOMC announcement to 30 days after the FOMC announcement. Why we pick 30 is because there are approximately 33 days between FOMC announcements, trading days. Then here we plot the R-square from the unbiased regression. Now what we observe is on the day of the FOMC announcement, there's a decline in the R-square. And interestingly, the R-square actually remains almost flat for 7-8 days before the R-square starts converging back to the linear line here, to under the linear increase under the benchmark of the random walk. At no time do we see a significant increase in the R-square around the announcement. That remains persistent. Now you might say, well, if you run this methodology around other news events, you might just get the same thing. Maybe there's something fishy going on with the methodology. Well, if I do the same thing for stocks and look at stock splits, and you know sometimes stock splits there tends to be a news about an increase in dividend, well, this is what we observe. We do observe an increase in the R-square at the time of the announcement. Similarly, for earnings announcements, we just use earnings announcements 2019. We observe the same thing. Okay. Now, what I'm going to do next, I'm going to look at the change in the R-square. So under the null of a constant information flow and no noise, R-square should increase by 1 over t. T is the number of days in my window of the estimation of the unbiased regression. We define the excess R-square as the R-square relative to 1 implied by the null, defined here, where k is essentially the number of days through which we observe the change in R-square. So if you look at only the R-square on a day-to-day, well, k is equal to 1. If you look at the change of R-square over 3 days, then k will be equal to 3. If the excess R-square is greater than 0, it implies abnormal information flow, net of noise. If the excess R-square is between -1 and 0, it implies below the normal information flow, net of noise. If the change in R-square is less than 1, noise dominates the information flow. Now here in this table, what I have is the change in R-square and the excess R-square for t equals 0. This is the day of the announcement, the day after the announcement, second day, and third day, and so on. The left column here, what you observe here is the window through which we have estimated the unbiased regression, so 30 days before the FOMC announcement to 30 days after the FOMC announcement. Under H0 here, this is the null of what should be the change of R² under the null of a under random walk. So on the day of the FOMC announcement, we observed a decline of 1.7% in R². And in terms of excess R², we have minus 2.02. The way you can interpret this minus 2.2, this means a decline of in information approximately equal to 2 days worth of information. The numbers in italic here are p-values from bootstraps. So we the first set of p-values are your typical bootstrapping, where we simply resample from the distribution of FOMC announcements. And the other p-values are calculated as we compare our point estimate to us drawing from other days within the same quarter on the same week of the on the same weekday of the FOMC announcements. And our null hypothesis here is whether the excess R² is less than 0. So in this case here, we find that the minus 2.02 here is statistically significant. For T1, T2, T3, they're not significant, however. But interestingly, the exchange of the excess R² remains negative. There's no evidence of a significant increase in R². Here, if we start at minus 20 to go to plus 30, minus 10 to plus 30, we find similar effects. If you do minus 10 to plus 20, the number is a bit smaller, but remains significant. If you do minus 10 to plus 10, however, the number is much smaller, and then it's not significant. But that's because 10 days after the FOMC announcement, there's still some noise into the price. So it's important that when you apply such methodology, that the endpoint is actually quite important. So again, like one key assumption when you apply these unbiased regressions is your endpoint that you use, you're making the assumption that this is the efficient price. So in our results here, noise dominates information for longer horizons. So even if you take t equal to 10, there's no statistical evidence, but that's because there's still some noise into prices. Our methodology is robust to the starting point. So no matter what you start at minus 10, minus 20, minus 30, it doesn't make much difference. Starting at t1 equals 0 is fine as well. And constraining the beta in the unbiasedness regression equal to 1 also gives similar results. If you zoom in on the FOMC announcement day itself, we find that the 65-minute announcement return, so 5 minutes before the announcement to 60 minutes after the announcement, and the rest of the announcement day contribute equally to the decline in R². So the change in R² on announcement day is equal to minus 0.16 when you exclude the announcement return, and equal to minus 0.05 just over the announcement window. If you zoom out and you look at the excess R² over the day 0 to 3, 4 to 7, 8 to 11, 12 to 15, following the FOMC announcement, and here we estimate over the window 0 to 30, we find that over the 3 days following the FOMC announcement, the decline in the excess R² is significant. It's not significant over days 4, 7, 8, 11, but that tells you over the 10 days that there's no point where there's a significant increase in the excess R². But we see here that over the day 12, 15, that the excess R² becomes positive. That's because noise dies out, and the R² goes back to its linear line that I've shown you before. So a possible explanation. Can our result be due to simply weekday effects? Because we know that FOMC announcements are between Tuesdays and Thursdays. Actually, we find that these days tend to be more informative. So actually, you can actually apply our methodology just to ask yourself, are Tuesdays more informative than Mondays? Which days is more informative in a given in a week? Actually, turns out that the Tuesdays and Thursdays are more informative. So, and also the second set of p-values controls for the potential weekday effects. Can our result be driven by a small sample or driven by outliers? We use the universe of FOMC announcements. Bootstrapping accounts for outliers, and we confirm in subsample that our results are robust, and it's actually more stronger in the latter sample from 2011-2019. Or maybe FOMC days have lower information flow than other days. This will be inconsistent with evidence of high volatility in volume. Also, it's rejected in other asset classes. So if you repeat the same methodology, not for market return, but use $, you'll find that indeed the change in $, on FOMC announcement is significant. So the R-square does jump. And our test, another possible explanation is that our test does not work for equity. While it's rejected using other macro news announcements, we do not observe abnormal decrease in excess R-square, for instance, for unemployment announcements or GDP. So what are the implications of our results? So what we call noise must necessarily revert. So our analysis identifies noise in individual announcements, but it does not need to imply overreaction, and it does not result into a drift of average returns. However, one thing we can do to provide some evidence that there is some noise and that the noise reverts itself, we can sort the FOMC announcement returns, and in order to provide evidence, and if we do so, then we also sort on noise realization. So here, what we have in this plot is I plot the cumulative returns 10 days before the FOMC announcements to 30 days after the FOMC announcements. The blue line corresponds to days when the FOMC announcement return is very positive. So the top quintile. The red line corresponds to FOMC announcement where the returns in the bottom quintile. And what you see here is at the jump of the FOMC announcement, the returns declines down. And if there's a drop in the FOMC announcement return, returns drift upwards. So both the blue line and red line eventually converge itself. Now the black line here corresponds to the middle announcement returns, but this trend here just corresponds to the average risk premium that you observe over a 40-day. So it's approximately 1.2%. Also, we can have a little more sense of where is the source of the noise comes from. So in our paper, what we call noise is very generally defined. It's anything that does not affect stock prices in the long run. But we can provide some sense of what is the source of the noise, where it comes from. So for instance, if we sort on the fitted announcement returns from regressing returns on Fed fund surprises, so your Fed fund surprises is your measure of fundamental news, we'll still provide evidence of noise. Oops. So here, I just sort the cumulative returns based on the fitted announcement returns after regressing returns on the Fed fund surprises. And what you find here is both the blue line and the red line also converges after 30 days. If the Fed fund surprise did have indeed a permanent price impact, you would observe that both the blue and the red line would remain parallel to one another for a long period. Eventually, would most likely converge, but probably over more than 30 days. Now you might say, well, Fed fund surprises is probably not the best measure of surprise because during the lower zero bound, there was not much Fed fund surprise. We redid this analysis using the Nakamura-Steinson measure of FOMC announcement surprise, and we find a similar plot.
You have 2 minutes. Okay,
all right,
you're on the conclusion.
Yeah, I'm on the conclusion. So we propose a new diagnostic method to measure incremental price informativeness. This allows us to examine if noise subsumes information flow. We apply our method to FOMC announcements and find that any possible information content is overwhelmed by temporary price effects. It appears that FOMC announcement returns are not efficient markets transitioning to a new macroeconomic equilibrium. In the next revision, we will apply our method to multiple news events and asset classes. But at that point, we're still debating on what is the best approach for it. So I look forward to Pavida's comments and other people attending the conference. So thank you very much.
Thank you very much, Charles. Finishing before time. And we have the discussant, Pavel Sabor from DePaul University. Very welcome. And while Paul is setting up, everyone else you can type your questions in the chat, or you can hold your question and then raise your hand when we get to the Q&A after Pavel's discussion. Sorry. Pavel, the screen is yours.
Well, first of all, good afternoon, or I guess good morning here in Chicago, and thank you for having me discuss this paper. Obviously, I prefer to do it in person, but it's a very good second best. You've heard from Charles about this paper, and I'm not going to spend too much time talking about it. Estimating how asset prices, mostly stocks, but also bonds, react to news is an age-old question in finance. And in some way, this is an issue that this paper revisit. It takes an old methodology, unbiasedness regressions, but instead of focusing on response coefficients, it focuses on Rsquare to test whether, well, effectively whether returns revert. And it applies this methodology to FOMC announcements with the conclusion that you just heard that, according to the authors, most of the stock price reaction to FOMC announcements seems to be noise. Again, noise meaning that the returns eventually revert. When they're high, they go down. When they're low, they go up. So before I continue, let me just offer a caveat for my discussion, although it's less necessary than I thought it would be, that my discussion is partly based on what the authors communicated to me as the future vision for the paper, as opposed to what the paper is right now. It's like a little bit change the focus again away from what you can see in the draft and what you could have heard from the presentation today to what the authors told me the paper eventually wants to be. So let me begin with FOMC returns, which the title says more or less seem to be irrelevant. Well, here you have to keep in mind that two different questions you can ask when you're thinking about really any type of announcement. You could ask yourself, what happens in response to news? So in our question, here, FOMC, what happens to stock prices when FOMC announces its interest rate decision? How do the stock prices react? So if you think of a simple regression, you could think of a regression where on the left-hand side, you have the realized returns. On the right-hand side, you have some measure of expected returns, at time t, the returns and the news are occurring at time t+1, plus news. And news is going to be, in this simple notation, ZT+1. Let's say what the Fed tells you about its interest rate decision. Our interest rate is going to be higher than expected, lower than expected, and beta then is going to be the so-called response coefficient. And we all know, well, we may not all know, but many papers have shown, perfectly intuitive results that corresponds to conventional wisdom that stock prices respond positively to expansionary monetary policy when rates are lower than expected, and respond negatively to contractionary monetary policy when interest rates are higher than expected. But that's not the only question you could ask here, right? Instead of saying, how do asset prices respond to news, you could ask yourself, well, let me measure risk premia associated with this news. In other words, instead of focusing on beta coefficient, focus on the first term, the expected return unconditionally at time t. So what I mean here, let's say investors really care about FOMC announcements because they provide some very important information that has systematic impact on everything. Well, then if you're a risk-averse investor, you may demand a higher risk premium to hold stocks on the day the FOMC makes its announcement compared to other days. And that would not be reflected in news. And this expected term is saying controlling for news, do investors expect, let's say if the risk premium is positive abnormal returns at these times? In other words, assuming the average surprise is 0, which it should be by definition, although in sampling may be different, what's the risk premium associated with this announcement? And as far as, I'm biased here because this is some of my own work, but as far as I can tell, this huge amount of attention that FOMC announcements have been getting recently is less in response to the beta coefficient. We kind of knew about it. There's nothing particularly complicated about it. It's more in response to these findings that the risk premium associated with FOMC announcement seems just extraordinarily high. So these charts are from a paper of mine on global central bank announcements, but focused on the panel A, the one in the top left corner, which is FOMC announcements. And what it plots there is announcement premium, which we define as the difference between average returns on announcement dates minus average returns on other, call them regular trading days. And what you could see, this announcement premium are positive, statistically significant, and the really, really high. And the really, really high part, I think, is why this announcement attracts so much attention. Now, in the US, depending on the sample you pick, they're roughly, between 20 and 60 basis points per day. And again, depending on the sample you pick, this means that at the very least, about 60% of the annual risk premium occurs just on these FOMC announcement days, of which there are 8 per year. And if you pick, the best case scenario, from the perspective of making FOMC announcements important, it's close to 100%. Basically, the entire risk premium is FOMC announcement. Now, if you're going to say that they're irrelevant, you can. And you can say, well, that means that people kind of overreact. They get very excited about the FOMC announcements, stock prices, go up, but then, 30 days later, all of that is lost. But that's not really what we see. Right? If you look at it, I took the same figure that Charles showed you. So this is splitting announcements based on announcement returns. So obviously, mechanically, on the day of the announcement, when the surprise is good for stocks, whatever good means, stock prices go up. When it's bad, stock prices go down. And when it's neutral, it's kind of close to zero. But what happens at the end of the horizon? Well, yes, we see some reversion, although it's not statistically significant, I think, at all, for both positive and negative news. If you kind of ballpark it here, after positive news, the returns are 1.75% roughly at day t equals 0. By t equals 30, 75 basis points of that is lost, reverted, if you want to call it that. But then for bad news, stock prices drop by 1%, but they end up being 50 basis points higher, meaning that the stock price actually increased by 1.5%. And for neutral middle announcements, they go from 0 to about again 1.7% seemingly. So if anything, if you kind of sum up these numbers in your head, the high average return on FOMC announcement days seems to be even higher 30 days afterwards. On average, again, I'm here not controlling for the surprise. I'm saying just take all FOMC announcements as they are and take the average. The assumption being that on average, news is going to be 0, right? By definition, you can't expect the average surprise to be positive or negative. So I think you're saying that FOMC announcements are relevant. I don't think even the paper offers evidence, any evidence really for that claim. What it's saying more is the reaction to FOMC announcement news seems to be too strong in both directions, but the premia still remain. So my second comment focuses more on the methodology, which I think, as far as I understand from the authors, is really what they want to push forward as the contribution of the paper. So what they're doing, they run a standard unbiasedness regression. On the left-hand side, you have a return over some period t, call it window t. On the right-hand side, the explanatory variables, some return over a shorter period. So you regress returns over a 30-day period on returns over a 15-day period. And if everything works perfectly let's say an unbiased, IID world, you would get that beta is 1. But they don't focus on betas. There is, again, the coefficients, which is what most people have done before. They focus on Rsquare. So what's an Rsquare? Well, an Rsquare is just, what amount of variation is explained by your model. We all know this. In this particular context, it's going to be 1 minus the variance of epsilon, the error term, over the variance of the left-hand variable return. Now, in this simple model, you can kind of work out that this R² is going to equal beta squared, the coefficient you estimate, times the variance of the right-hand return, the shorter window return, over the variance of the left-hand return, the longer window return. So now look at this. I was trying to work out kind of what the authors are doing. In my head, it wasn't working for me, so then I wrote it out. If you look at this may look familiar, at least it did to me. So let's do a little bit more. Let's focus on a simple one-day return. So set x in my notation to t minus 1, which is what the authors do in their table 2. They say, okay, let's just start with the announcement day return. Well, in that case, R² is just going to be beta squared over variance of the one-day return over the variance of the t-day return. Maybe even more familiar. Now, set beta equal to 1, which is, again, what the authors do in table 2. What do you get? Well, you get that the excess R², the key measure in the paper is, T over K, delta R squared minus 1. Plug in this simple input, you get that it's T, the number of days in your holding period or in your window, times the variance of the 1-day return, the FOMC day return, over the variance of a 30-day return, minus 1. Minus 1 is just to normalize, so that 0 is the IID world excess R squared. Well, what is this? If you look at this, now it's obvious. This is the old variance ratio test of Low and McKinley. It's exactly that, right? The test is exactly that. It is a test of whether 1 day or 1 month or whatever, variance times the length of the holding period is equal to the variance of a T-day holding period. And this has been used widely in basically tests of whether returns are predictable or whether they mean revert, which is at some level exactly what Charles and his co-authors want to do. Now, there's good and bad news here. The good news is that we actually know the distribution of this test statistic. Low and McKinley and Paterba and Summers are kind of worked out. This was pre supercomputing days, so it was harder to just bootstrap everything. They figured out what the distribution of this test statistic is, and we know it. So it, at some level, makes things easier. The bad news, at least for the authors, a little bit, is that the measure is not as new as you would think at first glance. And if the authors want to, and I guess that's where I'm going with this, if the authors want to make their paper about the methodology, which I think is a good approach, they need to focus a little bit more on kind of how that methodology is different from what we already do in the literature, where we kind of know what to do. Because as far as I can see, once you have a longer holding period and beta is not necessarily 1, it's not exactly the variance ratio test, but it's very, very similar to the variance ratio test. And we need to kind of know what's different here. Why is this better? How, or it never even be better, but how is it different? Again, in the case of 1-day returns and beta constraint 1, it's not different at all. It's exactly the same test. And these really are my two main comments. I don't know how much time I have left.
You have 2 minutes.
Oh, perfect. So then on a related point, the authors say, well, our methodology is better than standard reversal test, because standard reversal test would just say our returns autocorrelated, on FOMC announcement days. Regress returns at time T plus 1 on returns at time T, you get a positive coefficient, negative coefficient 0. But I say, well, our methodology is better because we don't have to pick the horizon. We don't have to know over which horizon reversals occur. And I just didn't understand that point because, as you've seen in the presentation of the paper, the key decision is how long is the window over which you measure returns. How long is the event window? But that's exactly the same thing as picking the horizon. There's no difference. If they focused on 10-day returns, they wouldn't find anything. They find things in 30-day returns, which is fine. We'd have certainly no prior, how quickly reversals occur to the extent they occur. But again, to me, that's exactly the same thing as in a kind of autocorrelation regression picking the horizon. 2 other minor comments. So just for the authors, contractionary, that's why I was using it earlier. Monetary policy means higher interest rates, not lower rates. I get where the confusion comes from. Contraction means, make smaller. So, make interest rates smaller, but, in the context of monetary policy, contractionary means higher rates. And I just mentioned this because it took me a while to figure this out. Like, what are they saying? Like, everything seems like, upside down world in the paper. But that's because the terminology is at least different from the conventional one. And then finally, I would just advise the authors, to the extent they make predictions, to bank them up by some models or at least reasoning behind them. So he claims like, our returns are as expected, our results are stronger for low volatility stocks, which is fine. I buy the results, but I didn't quite understand, where does the as expected part come from? If they told me returns are stronger results are stronger for high volatility stocks, I would have said fine as well. I just don't know. And you need to explain to me where your predictions come from. It can be a formal model, but maybe that's too much work, but at least your reasoning, this is why we think our results are stronger for low volatility stock or high market cap stocks, and so on. So on that note, I'm almost out of time. So again, let me thank the organizers for inviting me. Hopefully next time I'll actually get to travel somewhere as opposed to travel to my study. And I'll end here.
Thanks a lot, Pavel. Indeed, we hope you can come all the way to Stockholm next time. Charles?
It'll be a good time too. It's May, it's perfect time in Stockholm, right? It's
a perfect time. Charles, we have a fair bit of time. We have 8 minutes left for the session because you didn't use all your minutes before. So you have plenty of time to respond.
Yeah, I also want to take as much question as possible and get as much feedback. But thank you, Pavel, for the great discussion. I'm just going to say briefly, yeah, regarding the risk premium, just like you, I also have some stake in that game. So when we say the word irrelevance of FOMC announcement return, yeah, we might have to change the wording regarding it's not irrelevant when it comes to risk premium. It's just a question of whether or not the FOMC announcement return carries information about future prices. But I'm on the same page as you regarding the risk premium. And now regarding the methodology, that's actually a really good point regarding the variance ratios. That's something I have to think a bit more with Oliver and Vincent. And for the at the end, you had to have a model. This is something that we thought about as well. So something that we wanted to